I would like first to pay respect to the traditional and original owners of this land, the Gadigal people of the Eora Nation, to pay respect to those who have passed before us, and to acknowledge today's custodians of the land. I also extend that respect to any First Nations people joining us here today. 3 weeks ago, the Reserve Bank Board cut interest rates for the first time since 2020. Naturally, there is a lot of interest in what lies behind the board's decision-making process and where we go from here. So today, I want to shine a light on 3 key inputs to that process, how they interact with one another, and how they fit together to support the board in its decision-making. The first is our view of how changes in the cash rate affect the economy. The impact of policy changes takes time to flow through. So looking at the response of bank credit flows, for example, which many here today know intimately, clearly highlights this. So policy decisions today shape inflation and employment outcomes in the future. This necessitates a forward-looking approach to meeting our mandate. Policy decisions require both a view of the outlook for the economy and an understanding of how policy is likely to affect that outlook. That helps the board set the cash rate to give the best chance of achieving our mandate over time. The second key ingredient is how we form our view of the outlook, our baseline forecast, and how it responds to incoming data. When we talk about being data dependent, we are referring to the way we update our view of where the economy is and the outlook as we get new data. Now, the implication of continuously updating our view on the outlook means we also continuously update our policy advice to the board. The future pathway for the cash rate is not predefined. And finally, I want to say a bit about the board's approach to setting policy under uncertainty. In practice, we are uncertain about both the outlook for the economy and the effect of monetary policy, and this complicates policy decisions. Under uncertainty, policy decisions depend more on just the central forecast. Judgments about the risks and those uncertainties matter as well. And that's why, as we've discussed recently on a number of occasions, it's important to consider alternative possible pathways or scenarios for the economy and how policy would have to respond in those alternatives. So, to the first. While central bankers and macroeconomists often say that monetary policy impacts the economy with a lag. So, if inflation moves away from our target or employment falls below full employment, monetary policy can't immediately offset those moves. Instead, central banks have to look ahead. Now, ideally, we would know when and by how much the economy is going to deviate from our targets. And knowing this, we would calibrate policy today to prevent this from happening. So the economy would stay at full employment and inflation at target indefinitely. In practice, of course, that isn't what happens. We can't foresee shocks. And even in times of relative calm, outcomes are rarely, if ever, exactly as we expect. The economy and our understanding of it is always evolving, and our models, analysis, and judgments aren't perfect. I don't have a crystal ball at home or in the office, and even if I did, it'd be pretty cloudy most of the time. Despite this, given the lags in monetary policy transmission, we always have to forecast how we think the economy will evolve and set policy now, today, so that we expect to achieve our mandate once any policy changes have had time to have their effect. And of course, in practice, as I'll explain later on, we also have to take account of uncertainties. And that's why we put significant effort into identifying and understanding the risks around the baseline forecast. And the board explicitly considers such risks in its decision-making. So, it's important then to understand how policy changes affect the economy. In a speech in 2023, my colleague Chris Kent set out how the RBA's view of how monetary policy works and how the sequence of increases at that point in time in the cash rate had affected the economy. Now, I plan to use the same framework today to explore the lags in transmission, so I'm just going to briefly summarize it here and on this rather scary-looking diagram. Sorry to take everyone back to Macroeconomics 101. So, when the cash rate changes, the first step in transmission is that other short and longer-term market interest rates and other asset prices, including the exchange rate, adjust more or less straight away. Then these changes affect economic activity and ultimately inflation through a number of channels. First, the cash flow channel. Lower interest rates flow into households' disposable income. So borrowers pay less to service the debt that they might carry, their mortgage, and savers earn less on their deposits. And so we're looking at the net impact of those two. Second, the response of savings and investment decisions. A decrease in saving and borrowing rates typically encourages people and businesses to borrow, invest, and consume more and save less. So a net positive. Third, the impact of asset price movements. A cut in interest rates typically encourages investment in assets, resulting in higher house, equity, and other prices. Higher household wealth also tends to increase household consumption. We'll feel a bit better off and perhaps spend a bit more. Fourth, credit flows. Lower interest rates can increase the flow of loans to households and the availability of external funding to businesses, and that can help support activity. And finally, the exchange rate. A decrease in interest rates can contribute to a depreciation of the exchange rate, making imports more expensive and exports more competitive, leading to stronger GDP growth. Higher import prices also directly increase inflation via the cost of the products that we import from overseas. Now, macroeconomists often talk about expectations and whether or not an interest rate change is partially or fully anticipated by financial markets, households and businesses, is an important determinant of the size of each transmission channel. Or in other words, the impact of these does vary depending on the setting for the cash rate change. If the change is fully anticipated by financial markets, then we may see little, if any, change in asset prices and the exchange rate. They've already adjusted ahead of time, which limits the size of the exchange rate and asset price channels after the decision. Households and businesses may also start to adapt their spending and investment decisions ahead of a change in the cash rate, but they typically respond less than financial markets prior to the policy decision. So overall then, the size and timing of the impact of monetary policy changes through these channels varies. This is why central bankers will often say that monetary policy has long and variable lags in terms of its impact on the economy. So take the cash flow channel as an example. Some variable loan and savings rates change pretty quickly, as we saw following the board's latest decision. Households in aggregate have more interest-sensitive loans and deposits, so lower interest rates will increase household disposable income in an aggregate sense. That prompts higher spending by some borrowers, particularly those that are constrained by their disposable income. So if you were right up against it and you just are paying slightly less for your mortgage now, maybe you'll increase your spending. But overall, households typically adjust their spending by less than the change in their income in the short run. For those with fixed-rate mortgages, cash flows remain unchanged until their loan rolls over, though they might start adjusting their spending in anticipation of that, as we saw through the roll-off of fixed-rate loans over the last few years. Alternatively, we can think about the exchange rate channel. All else equal, an interest rate cut in Australia lowers the relative rate of return on Australian assets compared with overseas, and that's what typically leads to a depreciation of the Aussie dollar. This makes exports cheaper and imports more expensive. However, while the exchange rate adjusts immediately, the volume of traded goods responds more gradually. Domestic businesses will have existing contracts to purchase goods from overseas, and foreign buyers will be similarly committed to domestic exporters here. So if you have a trade deficit, which we do at the moment, then this price effect may exacerbate or increase it. But as these contracts come up for renewal, and as firms and consumers adjust their purchasing behavior, there will be a gradual increase in the volume of exports and a decline in imports, leading to an increase in net trade over time. For those that remember your first year international macro, that's the J curve that I'm talking about. So far, I've been discussing the direct channels through which cash rate changes impact the economy. They start working immediately, though as I've already said, they take time to play out, and how long they take to play out can vary. We also have to consider indirect spillovers, such as the impact of spending decisions by businesses, households, and importers on employment and income. For example, a business might hire new workers for an investment project that is made viable by a rate cut, boosting household income and spending. This ripple effect amplifies the direct impact of policy, and typically the ripples will take time to fully flow through and play out. Recent research actually suggests that these indirect effects could be a major part of the transmission mechanism, so we've got to think about them and consider them all the time. Now, there's a lot in all of what I've just said, and while identifying these channels helps us think through how monetary policy operates in practice with the data that we have and how we can unpack things, they're all operating at the same time, and there's no precise way to isolate or quantify the size of each one. Nevertheless, one simple way to build intuition about their relative roles is to look at how the components of GDP, so consumption, business investment, dwelling investment, and so on, evolve after a change in monetary policy. So to do this, we have to use a model of the economy. And here I'm using Martin, which is the RBA's main macroeconomic model, to illustrate the transmission of a reduction in interest rates. I think there are a number of useful and helpful insights that this chart shows, so I'm going to stick on it for just a while. The first one that jumps out to me, at least, the immediate GDP response to lower interest rates is relatively limited. It's a pretty small positive there. It takes time for everyone to adjust. So I'm not expecting to see much impact in the March quarter data, when we get it, of the board's decision at the February meeting. In Martin, in the model I'm using, it takes 9 to 12 months for a loosening in monetary policy to have its peak effect on economic output, or that's when the bars are highest. It's around about a year, or just under, after the change in interest rate. The effect from total investment is an important channel over that first year. And dwelling investment, in particular, responds relatively quickly compared with business investment, whose response builds more gradually. Now, intuitively, I think this makes sense. Businesses might immediately be encouraged to invest more by higher valuations and cheaper credit, but it takes time to get projects off the ground, to get people in the door to do the work, and some businesses will wait to respond once they see what happens to demand for their goods and services. Fourth thing I take away from this, changes in imports and exports also play an important role in driving the initial response of GDP, at least according to this model. So this highlights that the exchange rate is important and operates relatively quickly compared with other channels. I think we can probably all sympathize with the fact that if overseas holidays become a bit more expensive, we might choose to stay at home and head up to Queensland, and vice versa. Finally, the response of household consumption to lower rates is initially quite small, but it grows over time. Now, to me, this suggests that the cash flow channel that I talked about earlier, this starts working pretty quickly, actually plays a relatively minor role in the overall transmission mechanism. I think that's because the boost from lower debt payments is offset by the reduction in interest income for some households. So some households may well respond quite strongly, but others less so, and actually maybe reduce their spending. And in an overall aggregate sense, it comes up relatively small. The slow response also likely reflects the indirect effects of transmission channels and households' tendency to smooth their spending changes over time. Now, while it takes about 9 to 12 months for the cash rate to have its biggest impact on GDP, the effect on inflation, the peak effect, is estimated to be nearly twice as long, 15 to 18 months, as you can see on the chart. Now, this could be because it takes time for an increase in demand to affect the hiring decisions of firms and job search decisions of households, and that's ultimately what feeds into price setting. Or it could just reflect some stickiness in prices, and we've certainly seen sticky prices in the last couple of years. So, to sum up then, using Martin, the decisions that the board make today about the cash rate have their largest effect on economic output at the end of this year, and they're going to have their largest effect on inflation in the middle of 2026. It's quite a long time away from today. So, given what I've just said then, if we're going to set policy, give our advice, and the board are going to set policy, we need to understand definitely how changes in the cash rate affect the economy, but we also need a view on the outlook for the economy, a forecast, because we're impacting what happens tomorrow. So, this is where me and my team come in terms of forecasting. As forecasters, we're essentially trying to do two things. First, we try to understand the state of the economy now. And secondly, we use models and other types of analysis, looking at historical data patterns and what have you, and our own judgment, to extrapolate from the current state of the economy into the future. So what's going to happen over time? In both cases, this comes down to our understanding of the data, both quantitative information, such as official ABS data, surveys, financial markets, and qualitative information, such as what we get from our liaison program. Extracting reliable signals from noisy data and forming a coherent economic picture is pretty challenging. New or revised data can alter our view of the starting point or how the economy might evolve. And as things constantly change, we continuously update our views with new information. Now, in recent years, many central banks have described their policy setting as data dependent. Now, rather than meaning that policy responds mechanically to particular pieces of data, so inflation is X, therefore policy rate is Y, it's not what we mean. When we say we're data dependent, it's data dependent in the sense that incoming data affects our view of where the economy is today and the outlook. And this, in turn, influences the path for policy. At times of heightened uncertainty about how the economy is responding to shocks, for example, during the pandemic and immediate aftermaths, central banks may put a higher weight on real-time data relative to baseline forecasts and models. So at that point in time, the models weren't working so well because they were looking at a shock they'd never seen before. But these weights can and do change over time as conditions evolve and we learn more about how the economy is responding. Policymakers are always forward-looking and taking a forward-looking view. So how does this work in practice? Well, to give a sense of how we draw all of this together into a forecast, I'm going to use the example of our household consumption forecast from the latest SMP. One of our key judgments at that point was that household consumption growth had started to recover in line with the pickup in real household incomes. This judgment was informed by analysis of a range of timely indicators, such as the ABS household spending indicator and the credit and debit card spending indices that some of our big banks now publish, which are very helpful for us. Now, that data suggested that consumption growth had picked up in the December quarter. And just to recap, we didn't have the December quarter data when we did the SMP. But the question for us was this just a temporary pickup as financially squeezed households concentrated their spending around Black Friday and other sales? Was it something a bit more? Well, digging further into the data suggested that there was a bit more to it than that. Not surprisingly, spending on the types of goods that tend to have significant sales, such as household goods, homewares, clothing, they did grow quite strongly in the December quarter. But we also saw a modest lift in household disposable income from the middle of 2024, so the fundamentals were getting better. And discretionary spending that wasn't impacted by those sales, for example, eating out, also showed some signs of picking up. So that suggested that there was a genuine improvement in underlying momentum, and information from our liaison contacts also supports this assessment. Now, our read of the data is a crucial input to our forecasts. In fact, one way to think about a forecast is that it captures and projects forward what we think is signal from that data, and it strips out or disregards what we think is mostly noise and random volatility. Now, the outlook for consumption is just one part of the forecast, and we spend considerable time thinking about how different assumptions impact different sectors and how these interactions might magnify or offset one another. But underneath it all, the links between data, forecast, and policy sit at the heart of us saying that policy setting is data dependent. Now, finally, as I set out earlier, the link between our forecast and the board's policy decision isn't mechanical. It's not as simple as constructing our central forecast, then working out what the board needs to do with the cash rate to meet its objectives, and then providing them with that advice. The main reason for this is that there's always risks and uncertainties around that central forecast. The baseline pathway is just one of a vast number of possible outcomes for the economy. Board decisions are always made in an uncertain environment, which means thinking about the distribution of risks around the central forecast. One of the things that we're focused on right now is US policy settings and the impact of these on the global economy and how that's going to flow through to activity and inflation here in Australia. We've been using scenarios, analysis, and judgment to assess these types of questions. Now, as the Governor and Deputy Governor have both indicated recently, the February decision reflected a judgment by the board that it was the right time to take away some restrictiveness. But the board were more cautious than the market about the prospects for further easing. So in all of this, the RBA staff use a range of timely indicators to form its economic forecasts. These data help us to distinguish between temporary fluctuations and more sustained trends, and that informs policy decisions. And then, of course, the overlay to all of this, the board are also considering a wide range of possible outcomes and scenarios, analysis and judgment, to assess the implications of different policy paths. All of this to ensure a balanced and forward-looking approach. So that's why being forward-looking is not in tension with being data-dependent. In fact, I think they're very much aligned with one another. Thank you. I look forward to taking your questions.
Thank you very much, Sarah. I'm sure you'll all agree that was a very informative speech, and I feel like it's one that people will be referencing and looking back at for many years to come in understanding monetary policy. We have some. I'd encourage everyone, if you do have a question, to please think about one, and I will seek to sort of give you an opportunity. Before that, I might kick off with a couple of questions on my own. Sarah, I guess you spoke about the tension between being data dependent and forward-looking, and then there are consistencies. I guess one thing that sort of strikes someone that's been following central banks for a while is that for a while there was a struggle to get the forecast right, and whether that influenced policy is uncertain, but certainly affected the way central banks communicated and created all sorts of problems around the world. Now it feels like central banks, and particularly the RBA, are a lot more confident in their forecasts. I guess, would you agree? If so, what do you think has changed? Is it purely in the environment, or is there some process changes to it? And also, does that give you more confidence in setting monetary policy now that your forecasts are hitting the mark a bit closer?
I think there's a couple of things going on, and I think this is really in reference to, say, the last 5 years or so. The first rather obvious one, I think, is the pandemic. So when the pandemic hit, it was a huge, unprecedented shock, certainly in the context of forecasting. We don't have a historical data record of another pandemic and its impact. And so at that point in time, it was very hard to know what was going to happen and how it was going to play out. Lots of big assumptions to be made. And the models that we would typically use hadn't seen this before, so they didn't really know how to think about it, for want of a better description. I think what's happened over time, over the last few years, is the models have learnt and we've learnt. And so the models now are more reliable because conditions are more like what they've seen before. So we're not in another pandemic, thankfully. We've learnt a bit about how the economy is responding, and we're always doing that. There's always more to do and to improve on, but we're really focused on that. And so I think to the comments I made in the speech, it's more about the balance between what you learn from the data and how you think about and what your models will tell you. That balance does change over time as you're dealing with different situations and different conditions, but it's always coming together in a forward view. So I think it's a combination of a few things. In terms of confidence about policymaking, I'm not sure that that's necessarily changed. It's always hard. It's always a tricky decision, and there's always uncertainty to face. And so for me and my team, it's about helping the board with that in our advice, and then the board have got the tough decision to make.
Still on the forecasting theme, I know you were in the room earlier when Lucy Ellis, formerly of the RBA, was on a panel. And if hopefully I do justice in paraphrasing, but I think her comments were suggesting that her forecasts or the consensus of the private economists were viewing an economy where they thought consumption would be slightly weaker, where unemployment would be a bit higher, and therefore I guess the upshot or the consequences of that is they would probably think there'd be more easing based on the RBA would seem to have a sort of more upbeat or optimistic forecast. Is that correct? And also maybe do you have a sense of where those differences, what's causing those differences?
Yeah, so forecasters are always going to have differences of opinion. It's what makes the subject really interesting. We always love talking to one another and interacting and discovering where we agree and where we disagree. I think on the forecast, particularly around consumption, you can take a sort of a view on how much you think consumption is going to pick up in terms of growth momentum. We think it's going to broadly match with income. If we saw a bit softer than that, then that would be signs of maybe a bit of a cautious household. The savings rate would be lifting up if that happened. There's also some trickiness with consumption around energy rebates and when they roll off, and so when households start sort of having to pay for all of their bills as opposed to receiving that rebate, so different assumptions about that can have an impact. On the broader picture, and perhaps with the unemployment rate and the labour market, it's true we're a little bit below consensus, but we're all actually pretty close together. We're sort of holding at around 4.2% over the forecast horizon. Consensus is sitting around 4.4%. So they're not so far apart, I don't think. But these differences matter in the context of policy setting. And certainly, if we saw things were a bit softer, if inflationary pressures came off a bit more than we're anticipating, then that would change our advice to the board. And we'll find out over the next few months as the data starts to unwind.
We are out of time, but hopefully Michelle will allow me the luxury of at least getting one audience question in. If there are any, please raise your hand. I don't see any, so I will take that luxury and just ask one banking question because we are at a banking conference. I thought Jonathan Mott's comments were quite interesting about, the low percentage of people on certain income that were getting loans, and it seems like, well, the credit was this credit growth is happening more in investors that had higher incomes or more assets. And then we've also seen from bank data how most of the spending as interest rates was rising was from, older households that had saved more money and were sort of benefiting from high interest rates. And it just seems like there's a real bifurcation, in who's lending and who's spending. I know it's not your remit, I know it's not the RBA's remit, but I'm just wondering what the RBA's observations are. And I know the aggregate comes out, but some of the parts of the aggregate are quite bifurcated. Just wondered if you had any thoughts on that.
Yeah, and it's something that we're paying very close attention to. So we've been looking at the distribution of how households have travelled through the recent period for some time now. And we see the same in the data, that lower income households have struggled more through the current period. We think that's because they tend to have lower buffers, so less savings in the bank, and they might be having to spend more of their income anyway. So faced with a high inflation environment, it's really tough, and they're having to make some really tough choices. We know as well that those with a mortgage, particularly those that might have purchased relatively recently, who've got a high level of debt, so high LVR and high debt-to-income ratios, they're facing the most substantial increases in their repayments relative to their income. And so we know that times have been pretty tough for them. We don't see concerns from a financial stability perspective around arrears and things like that, but that doesn't negate the fact that it's been really tough for that group. And then, as you said, you've got the contrast of households who perhaps don't have any debt anymore. They might have paid their mortgage off already, maybe a bit older, and if they've got savings in the bank, then they've been beneficiaries of higher rates. So those distribution impacts really do matter. We care about the aggregate because we know that the aggregate is what drives ultimately inflation outcomes, labour market outcomes, and that's our mandate. But we are very mindful of this, and we are now actually exploring how distribution might impact the transmission of monetary policy. So maybe in a few years I come back and do another speech on that. So for us, these things matter through that particular lens, and then obviously colleagues in financial stability looking at that. But it's not to negate what's happening. There's always distribution shifts across the economy. They've perhaps been magnified in the recent period.
Excellent. Well, thank you, Sarah. I think we are out of time. So please all join me in thanking Sarah for her excellent speech. Thanks.